Morpho raises $175 million from a 16z and Paradigm to build on-chain credit lending protocol. Morpho has raised $175 million in a round co-led by Paradigm, a16z Crypto, and Ribbit Capital, according to a June 9, 2026 report from CoinDesk. Apollo Funds, VanEck, Circle Ventures, and Ledger Cathay also joined. The size of the check and the names writing it make this one of the larger infrastructure bets in on-chain lending this cycle. The raise lands during a weak tape. As of June 9, 2026, Bitcoin sits at 61,970, down 2.9% on the day and 9.4% over the week, with the Fear and Greed Index pinned at 15, or extreme fear. Capital chasing on-chain credit infrastructure while spot prices bleed says more about where these investors think the next decade of demand sits than about this week's price. The pitch is plumbing, not a bank. Morpho runs an open credit network. Instead of acting as a lender itself, it gives institutions and fintech firms the rails to build their own lending products on blockchain infrastructure. The framing matters. Morpho is positioning as the layer underneath credit products rather than a replacement for the banks and brokers that originate them. That distinction is also a go-to-market strategy. A protocol that competes with Coinbase or Kraken has to win their users. A protocol that powers the loan button inside Coinbase, and Kraken gets paid whether or not those users ever hear its name. Morpho's deposit base already reflects that approach. 11 billion in deposits, and a marquee client list. Morpho holds roughly $11 billion in deposits. Its loan rails sit behind borrow and earn features at Coinbase, Kraken, and Binance, and it counts Bitwise, Galaxy, and Anchorage Digital among institutional clients. That is a different customer profile than the retail yield products that defined the last lending cycle. These are firms with compliance teams, balance sheet constraints, and a low tolerance for the kind of opaque rehypothecation that sank Celsius and BlockFi. The presence of TradFi names in the round reinforces the direction. Apollo Funds is one of the largest alternative asset managers in the world. VanEck runs ETFs measured in tens of billions. Circle Ventures ties the round to the company behind USDC. These are not tourist investors looking for a quick token flip. They are firms with credit operations that benefit if origination, settlement, and collateral management move onto programmable rails. A counterweight to the lending contraction. The timing reads as a contrarian call. Crypto lending deposits have roughly halved from a $125 billion peak to about $60 billion as retail platforms retreated and the market repriced counterparty risk after the 2022 blowups. Pouring $175 million into lending infrastructure into that contraction is a bet that the next phase looks different. Smaller in retail hype, larger in institutional volume, and built on infrastructure that can be audited rather than trusted on faith. For users, the structural shift is worth understanding. When the loan you take against your crypto, or the yield you earn on a stablecoin balance, is routed through an open protocol rather than a single company's balance sheet, the failure modes change. Smart contract risk and oracle risk replace some of the counterparty risk that comes with a custodial lender. Neither is zero. The point is that the risk becomes legible, sitting in code and collateral parameters anyone can inspect instead of inside a private ledger. That legibility is also what attracts the institutions. A fund that has to explain its positions to auditors and regulators can do that more cleanly when collateral ratios and liquidation rules are public and enforced automatically. The same property that protects a retail borrower from a hidden insolvency makes the rails usable for an Apollo or a VanEck.